Good evening, everyone. Today we will be discussing financial life events and how to fit the pieces together. My name is Anthony Tanzola, and today I will be joined by my fellow team members Angelo Geis, Adele Hashimova, Andrew Sioka, and Evan Zales. To start today, we are going to talk about the ingredients of success. Financial planning comes down to multiple different ingredients, and the sooner you begin your financial planning journey, the more likely it is that you will succeed financially. And as students at college, your financial planning journey needs to begin now. Remember that money invested sooner has more time to compound. Although basic financial planning principles are the same for men and women, it is important to remember that women typically live longer and earn less. Therefore, it may be more difficult for them to plan for financial independence during retirement than it is for men. In our next segment, we are going to talk about a series of financial life events and how to go about them. The first life event we'll talk about today is getting started. Right now, you want to start to manage your life. You need to make sure that your social media accounts are clear of anything harmful in case an employer may look at them. You want to start to grow your skill set over time and begin to learn the basic principles of personal finance and develop a plan for your future. To do this, you should track your expenses and use a budget, have an emergency fund, control your credit score, and ensure that you have the right insurance that is best for you. You need to start to identify your goals and come up with a time horizon and the capital needed to reach these goals, and this is something that should be revisited annually. Next, you need to start saving for your goals, and in order to do this, you should save more money than you think is necessary, make saving automatic, determine your risk tolerance, take advantage of any employer matches to retirement plans, and control your spending. And finally, you need to make sure that your portfolio is managed either by you or by someone else, and that a rebalancing strategy is in place in order to reach your financial goals. The next life event that we will be talking about today is getting married. Just as couples take time to plan their wedding day, they should also start to discuss finances before tying the knot with each other. Many people have different financial habits. Some people are spenders, some people are savers, and some people are a mixture of the two. It is important that the couple can come together and agree on a strategy that works for both partners if they would like to achieve long-term marital and financial success. No one likes divorce, and everyone knows that divorce is very ugly, both personally and financially. It is true that the leading cause of divorce in the United States are financial problems, and over 55% of marriages in the United States actually end in a divorce. The graph here shows the median net worth of individuals as a percentage of net worth 5 to 10 years after staying married versus becoming divorced. As you can see from the graph, it is far more beneficial financially if a couple can stay married instead of getting a divorce. A couple needs to decide if they would like to have their accounts and finances as joint, separate, or as a mixture of the two. They need to revisit their financial goals and discuss the future that they plan to have with each other. Their saving needs to be automatic, and they should also have an emergency fund just in case of things going south. They should start saving for retirement immediately just in case they haven't already, and they should also start saving for any children that they may plan to have in the future. They should also review their beneficiaries as well as their insurance plan. It is very likely that the husband and wife are working for different companies, and many companies offer multiple different insurance plans. They should find the insurance plan that provides the best and cheapest protection that makes the most sense for the two of them. They should update their W-4 forms to show their status as a married couple and take advantage of any tax bonuses that come with this. They should also make a will just in the event of a death. As the saying goes, hope for the best and plan for the worst. Finally, they should just try the best that they can to make it work. It is very important that you do not have money secrets kept from your partner and that you avoid all bad debt as a couple.
Next life event is buying a home. So step 1, ensure the purchase aligns with your financial goals and budget to avoid future financial strain. Your credit score affects mortgage rates and approval, so check for issues like high credit card balances or late payments. Step 2, consider tax implications of home ownership. For example, when your major purchase is the renovation of your home, consider using a home equity loan with tax-deductible interest to fund it. Then build the tax benefits into your budget. Include tax saving from mortgage interest and real estate tax payments in your budget. Then re-examine your investments. If you hold a municipal bonds and move to a new state, consider reinvesting in bonds from your new state to maximize state-specific tax benefits. Then you need to update your employer records. And lastly, you need to familiarize yourself with your new state's tax information by visiting tax website that including cost of auto registration and income tax rates. So step 3 will be post-move essentials. You need to notify all financial institutions to avoid missing bills or important documents. You also need to adjust home and auto insurance policies to reflect the value and location of the new property. High-risk areas may increase premiums. Next life event is when you and your spouse are having a child. So based on US News and World Report estimates that a medium income family may spend over $1.45 million over 22 years on a child. So financial planning helps ease the cost associated with this life event. So step 1 would be assess your current financial situation by reviewing your current finances to understand where you stand, secure an emergency fund to cover unexpected expenses, and know your financial position before planning ahead. Then re-examine your financial goals. So short-term goals may include upgrading to a larger living space versus long-term goals might involve saving for your child's college tuition. Then revise your budget by adjusting it to reflect new expenses related to child rearing. Factor in any potential income changes if you or your spouse decides to reduce work hours or take a career break. So ensure continued contributions towards retirement to secure your future even as you adjust for current needs. So this table shows you what you might do with just some of the money it takes to raise children if you decide to pass on parenthood. It compares it with what you might spend the money on for yourself if you don't have children. So then step 2 is plan for college. You need to begin saving as soon as possible to ease the financial burden for college expenses. Then you need to estimate the cost. You can use online tools like College Cost Calculator to project college expenses. Also, you can open a 529 saving plan, which is a tax advantage account specifically for education savings. Then you need to set up automatic deductions from your paycheck into your college savings account to ensure consistent contributions without extra effort. Step 3 would be reconsider your insurance needs. When you have a child, your insurance requirements will shift to ensure your family's financial security, so review and update life, health, and disability insurance coverage. So step 4 would be update your wills and trust. With a new child, it is essential to revisit your estate planning to ensure their future security, designating a guardian and establishing clear provisions for their care if something happens to you and your spouse can provide peace of mind. So you need to update or make a will, and you need to also update retirement account beneficiary designations by contacting the retirement and benefits department where you work to update beneficiary details, aligning your designations with your current family priorities. So step 5 would be to take advantage of tax savings. Having a child can provide valuable tax benefit. So obtain a social security number for your child to qualify for tax benefits. This allows you to claim tax breaks as IRS requires your child's name and social security number for such exemption. Then adjust your W-4 form to reflect the new exemption. This will help ensure your withholding accurately reflects your family situation, potentially increasing your take-home pay. Then, if you don't already have FSA, check with your employer about setting one up. FSAs allow you to set aside pre-tax dollar for medical expenses. With a child, you may have additional medical costs, and FSA can help lower after-tax costs for these expenses. Now let's talk about inheritance, bonuses, or unexpected money. So step 1, you need to examine the priority of your goals. Use this windfall as an opportunity to achieve important goals that may have seemed out of reach. Evaluate your financial priorities to see how this money can best serve your long-term aspirations, whether it is paying off debt, investing, or saving for future needs. Step 2, you need to examine your goals. Take a look at them and assess which ones are most important to you. Then adjust timeline. With an extra money, consider whether you can reach certain goals sooner than planned, like upgrading to a larger home, investing in retirement property, or paying off specific debts. Lastly, avoid impulsive spending. So step 3 would be to consider estate planning. If you have a large estate, you might want control over how your assets are distributed after your passing. This is where estate planning comes in. With estate planning, you can ensure that your assets are transferred according to your wishes. So step 2 will be to examine the tax implications. Depending on the source of your windfall, there could be taxes involved. For example, bonuses or prizes are taxable, while inheritances typically are not. Ensure any potential taxes are factored into your budget. Lastly, if your estate has grown significantly, it might be subject to estate taxes. So stay informed about any changes in the tax code and take steps to minimize your estate tax burden if applicable. So next life event is a major illness. So step 1, you need to re-examine your finances to understand the resources available. You need to ensure you have enough liquidity to cover unexpected expenses. Your future financial goals may need to be adjusted based on the new challenges and requirements posed by medical expenses. Then you need to re-examine your investment strategy, possibly assessing retirement savings earlier than planned, so consider shifting your investments to lower risk options to avoid significant losses that could affect your financial security. Then you need to revise your budget by adapting it for new expenses and revisit financial objectives, aligning with your current financial situation. Then step 2 is to take advantage of tax breaks. Your medical expenses and copays can be tax deductible. Refer to IRS Publication 502 to see which expenses qualify, and then check with your employer's benefits department to see if FSAs are offered. These accounts allow you to set aside pre-tax dollars for eligible medical expenses, reducing your out-of-pocket costs. Now, step 3 would be to consider alternatives to finance your illness. So look into your reverse mortgage, which is available for homeowners age 62 and older. It allows you to stay in your home while accessing equity. However, the home will go to lender, not heirs, when you pass away. Then we have life insurance. If you have a cash value life insurance policy, you may borrow against it. Cash value loans don't need to be repaid but reduce the death benefit. In terminal cases, some policies allow early access to benefits to support your needs. Lastly, we have disability insurance, which provides financial support if illness or injury prevents you from working. Options vary by policy covering short or long-term disability.
Supporting elderly parents involves addressing healthcare and estate planning early on to ease future challenges. Maintain their finances with care, organize paperwork, and understand their goals and budget. Ensure they receive benefits like Social Security, and help develop a workable budget. Protect their finances from fraud. Ensure they have a healthcare proxy and financial attorney, and confirm their will and wishes are clearly made to the family. It's important to discuss long-term care options and insurance, considering costs and eligibility for long-term care policies. For larger estates, estate planning with an attorney can minimize taxes and ensure smooth asset transfers. Early planning prevents conflict and safeguards their legacy. Retirement is a time to enjoy life, but it requires careful planning. Rely on savings, pensions, retirement plans, and Social Security for income. Prepare mentally and financially. Retirement changes your routine, social life, and identity, so psychological and financial readiness are key. Save enough for your desired lifestyle and explore plans like 401ks, IRAs, and Roth IRAs. Next, choose a withdrawal strategy to make assets last and to minimize taxes. Some options are the 4% rule, where you withdraw 4% of your portfolio annually, required minimum distributions, where you can start at age 73 to reduce taxes, or bucket strategy, to use short-term assets first, letting long-term investments grow. Also, make sure to monitor your investments and maintain an emergency fund. You should also review insurance options for income loss and understand Medicare. Part A deals with hospital care, Part B deals with outpatient services, Part C combines both Parts A and B, and Part D is assigned to prescriptions. You could also consider Medigap, Medicaid, or long-term care insurance if needed. Also make sure to update homeowners insurance and your will. It's also very important to know key retirement planning dates. Apply for Social Security at age 61, collect at age 62, collect full benefits at age 67, or maximum benefits at age 70. You are automatically enrolled in Medicare if you receive Social Security benefits before age 65. Otherwise, apply at age 64. Before 59 and a half, withdrawals are considered premature distributions, which may be subject to a 10% penalty. And then starting by April 1st on the year you turn 73, you must begin taking required minimum distributions. And at age 62, you can apply for a reverse mortgage. Losing a loved one is emotional, and managing their finances can be overwhelming. Make sure to gather documents by obtaining at least 10 death certificates, insurance policies, Social Security numbers, military discharge papers, marriage certificates, and birth certificates for dependents. Locate the will to guide asset distribution. Next, claim benefits. Contact insurers, Social Security, and past employers to access survivor benefits. Then, handle the estate. As the executor, manage probate, pay taxes and expenses, and fulfill financial obligations. Without a will, state law will determine the asset distribution. Next, update ownership. Change insurance beneficiaries, retitle vehicles, bank accounts, stocks, bonds, and safety deposit boxes, and adjust credit card accounts as needed. Finally, review your finances. Reassess your financial and retirement needs. If your benefits change, check with your spouse's employer for any owed benefits. If covered under the insurance, consider COBRA for temporary health coverage. Divorce can be financially challenging, but these steps can help you protect your future. Pay down shared debt by simplifying asset division and reduce divorce costs. Understand your finances thoroughly. Then, address joint accounts. Pay them off, open individual accounts, and request to re-age late payments on your credit report. Then, reevaluate your goals. You may qualify for Social Security benefits based on your ex-spouse's earnings. Plan accordingly. Then, maintain insurance. Ensure healthcare coverage through your own policy or COBRA, and update life insurance policies for alimony or child support needs. Finally, adjust your budget. Reflect new income and expenses. Reassess keeping the house if it's not affordable. Maintain retirement savings and build an emergency fund. Check for tax breaks as divorce may impact your filing status.
Hi everyone, my name is Andrew Sioka. I'm going to be presenting on 17 point. The next key is to live below your means. Make an effort to save by cutting up. Number 6 is embrace the B word, also known as budget. Number 9, stocks are risky, but not as risky as not investing in them. Number 11 is plan for the number of children you want, especially today. Children are very...
Hi everyone, my name is Angelo Geis, and I'll be presenting on 17.4, which ties a lot of the concepts we have talked about together in this course and focuses on debt in the real world. So, there are 6 keys to successful debt management. The first key is to spend less than you earn and to budget your money. Living within your means is imperative because to save and invest, you first need the money to do so. This can be achieved by spending less than you earn and avoiding charging expenses you can't afford. Additionally, you should be dictating when and how you go into debt, as well as consistently following a budget and savings plan. This will allow you to build your savings in case of emergencies and also invest for future goals such as retirement and education. The second key is to know the cost of borrowing. You must know your credit terms and any fine print information of loans you are signing off on. High interest on even small items can accumulate to make a small purchase expensive. Thus, high-cost loans such as payday loans must be avoided since they can reach rates of 400% annually. It is also important to think long-term and choose reputable lenders. You need them to be trustworthy and not hide costs or charge excessive fees. The debt that you take reduces future spending power, so do so wisely. Key 3 is all about understanding the difference between good and bad debt. Good debt involves strategic borrowing for long-term value. Borrowing is beneficial when it supports a long-term goal, offers lasting value beyond the financing period, and provides a return greater than the cost. Examples of this are education loans and home mortgages. Bad debt decisions include taking high-risk debt and ignoring creditors. Bad debt includes the high-interest loans referenced in Key 2. Thus, you want to avoid borrowing for day-to-day needs. And if you can't fulfill your debt obligations, you can't just ignore the creditor. Many lenders will help you reshape your payment plan since avoiding debt collection is in their best interest as well. So, for Key 4, you must make sure you can repay. Borrowing limits are personal, so don't solely rely on commonly accepted lenders' limits. Assess your own debt comfort level. Additionally, you must be aware of lenders that try to push lending limits as they could be doing this for personal benefit, and this could be to your own detriment. It is also important to manage debt after major purchases. Adding additional debt through items like furniture, cars, or electronics after securing a mortgage can cause payments to stack up. A good way to keep this in check is to be aware of your debt-to-income ratio and follow debt management limits. Key 5 is to keep your credit score strong since it keeps costs down and is a source of emergency money. Keeping a strong credit score helps save on borrowing costs. A poor credit score can limit access to important items such as loans, housing, and even job opportunities. A poor credit score can also result in higher borrowing rates and cost you thousands more over time, especially on significant loans like mortgages. In order to protect your financial well-being, it is important to avoid maxing out your borrowing limits and regularly review credit reports. Keeping borrowing capacity available for emergencies gives you flexibility and reduces the need for a large emergency fund. Regularly reviewing credit reports is imperative so that any errors can be fixed quickly to maintain your credit health and borrowing power. Key 6 is to not live with bad and expensive debt. I previously touched on some sources of bad debt, like payday loans. Another means of debt that can be bad is a credit card debt if you are not paying off your balance monthly. Many credit card companies offer 0% teaser rates on new cards, but these rates expand to 18 to 20% or even higher. So to reduce debt, you can negotiate or pay off high interest debt using funds from lower interest investments. At the end of the day, it comes down to making lasting lifestyle changes that mean you are living below your means. Here are some early warning signs and lenders to keep in mind when finding a new lender. This list includes lenders that encourage falsifying information, pressuring you to do something you're not comfortable with, or misrepresenting or concealing key details of agreements. When thinking about your financial situation and the debt that you take in, it is important to not fall into the Prince Charming bias. This bias reflects the belief that an improbable event like winning the lottery will suddenly resolve financial problems and bring wealth. This bias is well represented by the majority of lottery tickets being purchased by lower income individuals. Thus, a rational financial approach where you aren't taking on unnecessary debt or relying on unrealistic quick fixes is key. In order to build good financial habits that don't involve a Prince Charming bias, you must replace your bad financial habits. Habit changing, according to studies, takes 66 days and requires introspection to figure out where you are currently coming up short and where you can improve your financial approach. So, in wrapping up the book, here's a financial action plan to follow. Activities include budgeting and planning, managing your cash, if you have bad debt, getting rid of it, putting a safety net in order, and investing for retirement with a focus on tax favorable plans. And some key ideas to remember are to live below your means, don't worry about keeping up with the Joneses, make good money management a habit, and to build your financial knowledge to a point of financial autonomy. Thank you for your time.